What makes the committee inclined to think that the Fed funds rate at this level is not yet sufficiently restrictive, especially when officials are forecasting a slightly more benign inflation outlook for this year? There's noted uncertainty about policy lags. Headwinds have emerged from the looming government.
Also, you guys know the way I think. The Q&A is going to have a much bigger impact on prices on the charts than the actual statement, because they're going to ask them curveballs.
I would characterize the situation a little bit differently. So we decided to maintain the target range for the federal funds rate where it is at 5.25% to 5.5%, while continuing to reduce our securities holdings. And we say we're committed to achieving and sustaining a stance of monetary policy that's sufficiently restrictive to bring down inflation to 2% over time. We said that. But the fact that we decided to maintain the policy rate at this meeting doesn't mean that we've decided that we have or have not at this time reached that stance of monetary policy that we're seeking. If you looked at the SEP, as you obviously will have done, you will see that a majority of participants believe.
Now, look, all personal things against Powell aside, what he's saying is that you can't just do this month by month. You have to look at the data in an aggregate sense. This is kind of just one of those stepping stone months where we just got to see where things go. And so he doesn't know that. He's not saying that this current 5.5% target range is not good enough for us to be able to beat inflation. He's just saying we don't know yet, and we're going to have to find out to see if that's the truth. That's just me giving him the benefit of the doubt.
Sufficiently restrictive. You're not saying today that we've reached this level.
We're not saying, yeah, no, clearly what we decided to do is maintain the policy rate and await further data. We want to see convincing evidence, really, that we have reached the appropriate level. And then, we're seeing progress and we welcome that. But, we need to see more progress before we'll be willing to reach that conclusion.
And just on the 2024 projections, what's behind that shallower path for interest rate cuts and the need for real rates to be 50 basis points higher?
Right. So I would say it this way. First of all, real interest rates are positive now. They're meaningfully positive. And that's a good thing. We need a policy to be restrictive so that we can get inflation down to target. Okay. And we're going to need that to remain to be the case for some time. So I think, remember that of course, the SEP is not a plan that is negotiated or discussed really as a plan. It's accumulation really. And what you see are the medians. It's accumulation of individual forecasts from 19 people. And then what you're seeing are the medians. So I wouldn't want to, bestow upon it the idea that it's really a plan. But what it reflects, though, is that economic activity has been stronger than we expected, stronger than I think everyone expected. And so what you're seeing is this is what people believe as of now will be appropriate to achieve what we're looking to achieve, which is progress toward our inflation goal, as you see in the SEP.
What's dangerous is that people doing well in this country is directly against what the Fed needs for their play to happen. And so it's like, yeah, you guys are doing great, but that's not good enough for us. It's like, I'm trying to figure out how this makes sense.
Or holding steady.
They printed too much money, so prices went up. And now, like an economy that's flourishing and that the demand is here and people are still spending money. And the reason inflation is high is because we all still have jobs and we're spending. They're like, yeah, no, that's the problem. No, the problem was the $17 trillion they introduced. It's not people who have jobs and who are spending money that's really the lead of inflation. This is ridiculous stuff.
It's an SEP meeting. And so people write down what they think. And you have some, you saw, ridiculous. I think 7 wrote down no hike at this meeting or between now and the end of the year. And I think 12 wrote down another single.
He said no hikes today. Yeah, there's going to be no hike today. And because of his tone, people, I'm bullish. At this point, I am bullish. And I'm looking to see a retest of this 15,106 zone so I can go long. It's a very high probability level that we haven't tested just yet. I would very much like to see a retest of that level, but we might not get it. All right. So we're about 80 points away from that level. I'm not going to chase because then you guys can see, look, this is a 4-to-1 trade. If I chase the market and enter right now, it's only a 1.8 to 1, which isn't the worst thing in the world. It's still a great opportunity, but no, 4-to-1 would make a lot more sense for me. And I'd be able to go much, much heavier on the size with a smaller stop loss.
That's the progress that we want to see. But I think people, they want to be convinced, they want to be careful not to jump to a conclusion really one way or the other. but just be convinced that the data, support that conclusion. And that's why, given how far we've come and how quickly we've come, we're actually in a position to be able to proceed carefully as we assess the incoming data and the evolving outlooks and risks and make these decisions meeting by meeting.
And in your view, I know nothing has been decided yet, but what would one more hike at the end of the year do to the economy or to inflation? And on the other side, what would no hike do, if you could sort of game that out for us?
So, you can make the argument that one hike one way or the other won't matter, but for us, we're trying, we've obviously as a group.
He said one hike will make a difference in how bad things get. So even if they hike rates again, because of this expectation that it's not going to have that big of it might not even have that big of an impact. That's kind of crazy to me.
If you go back a year and what we thought,
He's kind of set up the play for himself.
It's actually gotten higher and higher. So we don't really know and that's why, again, we're in a position to proceed carefully at this point. A year ago, we proceeded pretty quickly to get rates up. Now we're fairly close, we think, to where we need to get.
Okay. Some honesty there.
It's just a question of reaching the right stance. I wouldn't attribute huge importance to one hike in macroeconomic terms. Nonetheless, we need to get to a place where we're confident that we have a stance that will bring inflation down to 2% over time. That's what we need to get to. And we've been moving toward it. As we've gotten closer to it, we've slowed the pace at which we've moved. I think that was appropriate. And now that we're getting closer, we have the ability to proceed carefully.
Let's go to Steve.
Well, let me give Jay Powell credit. When he first launched this war against inflation, because we all knew that printing all this money was going to have us fucked up. And when he took a stance against inflation, I didn't think he was going to be this adamant about it and this kind of like on a crusade about it. And that's exactly what we need to fight this inflation crisis. It's not going to get fought through simple discussion, all this bullshit. It really takes somebody to be very focused on it for a prolonged period of time. I have to give Jay Powell his credit for that, because other chairmen would have been like, well, I want a career after this, so I'm not going to fuck up the whole economy. Jay Powell's like, fuck my reputation. I need to get this under control. We got to give him credit. Historically speaking, he's going to be remembered as a hero for this, as long as he stays true to that direction.
I guess I would point more to, rather than pointing to a sense of inflation having become more persistent, I wouldn't think that's not, we've seen inflation be more persistent over the course of the past year, but I wouldn't say that's something that's appeared in the recent data. It's more about stronger economic activity, I would say. So if I had to attribute one thing, again, we're picking medians here and trying to attribute one explanation, but I think broadly, stronger economic activity means rates. We have to do more with rates, and that's what that meaning is telling you. In terms of what the neutral rate can be, we know it by its works. We only know it by its works, really. We can't the models and the economy reacts. And again, that's another reason why we're moving carefully now, because there are lags here. So that it may of course be that the neutral rate has risen. You do see people. You don't see the median moving, but you do see people raising their estimates of the neutral rate. And it's certainly plausible that the neutral rate is higher than the longer run rate. Remember, what we write down in the SEP is the longer run rate. It is certainly possible that the neutral rate at this moment is higher than that, and that's part of the explanation for why the economy has been more resilient than expected.
Let's go to Howard.
Howard Schneider with Reuters. Thank you. So you've said several times that the economy needed a period of below trend growth to get inflation consistently back to 2%. You kind of get that in 2024 a little bit. 1.5% is just a touch below what's the estimate of potential. So the fact that you're getting so much done at so much less cost, does that represent a change in how you think inflation works?
So how much power does the president have over Jay Powell? That's a really good question. It's not power, but it's influence. Power means that the president has power over the FBI director, right? Because he can actually tell him what to do. But when the Fed's mandate is that it's an independent agency from the government, and so it's supposed to be apolitical, regardless of who the president is. They're actually not bound by that. They're bound by the Board of Governors, who's their governing body. But the Board of Governors is appointed by the president and then approved by Congress. And same with the Fed presidents, appointed by same with the Fed chairman, appointed by the president, confirmed by the Senate. So Biden is his boss, and he put him in this position. So at the end of the day, you kind of have to take that into account. Whatever your boss really wants, you're going to take that into consideration.
Gap between,
But they're supposed to be an independent agency, completely independent, focused on price stability and stability of the dollar and maximum employment.
achieve a better balance. So all of those things are happening. You're right. In the median forecast, we don't see a big increase in unemployment. We do see an increase. And but that really is just playing forward the trends that we've been seeing. That is not guaranteed.
Also, y'all, prices are getting pretty close to my entry. I'm going to be taking a trade at that level. I'm going to split up my entry just in case that this is like a false flag and we break through. This is my strategy, 88.6, break retest from the daily lows. It's very simple. I'm going to split up my position in 3 parts. 1 on the first touch, 1 if it breaks through, just so I can get a much better entry, like a wick entry, and then 1 on the retest back in. So if I'm going to throw 30 lots, I'm going to do 10, 10, 10. If you're going to throw 3 lots, you do 1, 1, 1. And if you're going to throw 0.3 lots, you're going to do 0.1, 0.1, 0.1. Now, ideally, the way that you would best split this up is you would enter a standard lot at the 886 and then 2 standard lots below it in case it breaks through, so you can get an even better entry. So I'm going to split that up. You guys are going to see me take them live. If you have any questions, put them in the chats.
By factors that are outside our control at the end of the day. But I do think it's possible. And you know, I also think you know, this is why we're in a position to move carefully again. That we will restore price stability. We know that we have to do that, and we know the public depends on us doing that. And we know that we have to do it so that we can achieve the kind of labor market that we all want to achieve, which is an extended period, sustained period of strong labor market conditions that benefit all. We know that. The fact that we've come this far lets us really proceed carefully, as I keep saying. So, you know, that's the end we're trying to achieve. I wouldn't want to handicap the likelihood of it, though. It's not up to me to do that.
Nick Timmeros of the Wall Street Journal. Chair Powell, both you and Vice Chair Williams have indicated that sufficiently restrictive will be judged on a real rather than nominal basis, implying some scope for nominal rate cuts next year, provided further compelling evidence that price pressures will continue to subside. Is the FOMC focused on targeting a real level of policy restriction? And can you explain what would constitute enough evidence that will allow the FOMC to normalize the nominal stance of policy while keeping real policy settings sufficiently restrictive?
I mean, yes, we understand that it's a real rate that will matter and that it needs to be sufficiently restrictive. And again, I would say, you know, sufficiently restrictive only when you see it. It's not something you can arrive at with confidence in a model or in various estimates, you know. And so what are we seeing? We're seeing, you know, through a combination of the, you know, the unwinding of the pandemic related demand and supply distortions and monetary policies work in suppressing demand or alleviating very high demand. The combination of those two things is actually working. You're seeing, you know, inflation coming down. It's principally now in goods, also in housing services. You begin to see effects of it in non-housing services as well. So we think that is working. And I think, well, you know, as we've said, we want to reach that. We want to reach something that we're confident it gets us to that level. And I think confidence comes from seeing, you know, enough data that you feel like, yes, okay, this feels like it. We can for now decide that this is the right level. And just
one of my biggest problems is being too accurate, where, you know, I might miss a trade, sort of like trying to squeeze out the last 5 points or the last 10 points of the move. So I really hope we kind of come back down to that entry point. Otherwise, we may have missed a pretty good low, kind of like the low of the day entry, trying to squeeze out the last few pips. So I am going to be patient and wait for it to come back down to that 105 level. But just so you guys know, that's what I'm watching for here.
That's the stage of
This year. And even then, it seems possible the core PCE inflation could come in even lower than the median at 3.7. would you see a case to raise rates still if it turned out that you were going to achieve the same real rate this year because the decline in inflation proceeds somewhat better than you currently anticipate?
Great question, bro.
The decision
Great
that
question.
we make at each meeting
Who
and
the fuck is that
certainly
guy?
at the last two meetings this year, it's going to depend on the totality of all the data. So the inflation data, the labor market data, the growth data, the balance of risks and the other events that are happening out there. We take all of that into account. So I can't really answer a hypothetical about one piece of that. It'll be trying to reach a judgment over whether we should move forward with another rate hike overall, and whether that would increase our confidence that yes, this is an appropriate move, and it will help us be more confident that we've gotten to the level that we need to get to.
Yo, let's do a funny wager. Put a 1 in the YouTube comments if you think that my break even is going to get hit on that entry from yesterday, and put a 2 if you guys think it won't get hit, and that we're going to come down to this 1591 level and reject, and my break even is going to be safe. By the way, this is a trade I took yesterday after the live session. We ended up getting in, re-entering that same trade that we were trying to take. Ended up going into deep profits yesterday, over 150 points. But let me know, people. If you guys think, put a 1 if you think my break even will get hit, put a 2 if you think I'm going to glide by it.
You're out those discussions, and people interpreted that to mean that you didn't see a possibility of a rate cut in the first half of next year. And I wonder if that was what you meant by that, or whether, how you're thinking about that timing.
No, when I answer these questions about hypotheticals about cutting, I'm never intending to send a signal about timing. I'm just answering them as the question is expressed. So please, I wouldn't want to be taken that way. Sorry, the first question was that how? Yeah, so we're as we go into next year, that's the question we'll be asking is, taking into account lags and everything else we know about the economy and everything we know about monetary policy. The time will come at some point, and I'm not saying when, that it's appropriate to cut. Part of that may be that real rates are rising because inflation is coming down. Part of it just may be that it'll be all the factors that we see in the economy. And, that time will certainly come at some point. And what you see is us writing down, a year ahead estimates of what that might be. And, there's so much uncertainty around that. When we, in the moment, we'll do what we think makes.
CA members, I know you guys see what I'm looking at here. Phase 1, phase 2, 3, and then 4. Y'all got me?
Neil Irwin with Axios. I wonder, how do you think about the question of whether the strong GDP growth we've been seeing is driven by excess demand versus supply side factors, productivity, labor force growth? And relatedly, if GDP keeps coming in hot, even in the absence of inflation resurgence, would that on its own be a reason to consider more tightening?
So on your first question, I mean, we're looking at GDP very, very carefully to try to understand really what's the direction of it, what's driving it, and it's a lot of consumer spending. The consumer's been very robust in spending. So that is, that's how we're looking at it. Sorry, your second question was?
There's GDP stays hot, but without inflation.
So I think the question will be, GDP is not a mandate, right? Maximum employment and price stability are the mandates. The question will be, is GDP, is the heat that we see in GDP, is it really a threat to our ability to get back to 2% inflation? That's going to be the question. It's not a question about GDP on its own. It's you're expecting to see this improvement, continued rebalancing in the labor market and inflation moving back down to 2% in a sustainable way. We have to have confidence in that, and we'd be looking at GDP just to the extent that it threatens one or both of those.
Victoria.
Hi, Victoria Guida with Politico. There are multiple external factors that are playing out right now. We see
These are some solid questions, right? This is the kind of shit I was expecting at Jackson Hole, but he just ended up getting up there, doing his piece, and then hopping off. This is much more thorough of an explanation. I like this a lot. This is going to give us direction for the next 2 months of market action. I think we're going to end up recovering here for the next 2 months, but we'll see which direction the market takes. I think we're going to have the same trend for the next 2 months. Bullish for the next 2 months or bearish? I bet bullish.
There are a lot of things that you can look at. And, you know, so what we try to do is assess all of them and handicap all of them. And ultimately, though, there's so much uncertainty around these things. I mean, to start with the strike, first of all, we absolutely don't comment on the strike, as we have no view on the strike one way or the other, but we do have to make an assessment of its economic effects to do our jobs. So, you know, the thing about it is so uncertain. It will depend. The economic effects, it could affect, we've looked back at history, it could affect economic output, hiring, and inflation, but that's really going to depend on how broad it is and how long it's sustained for. And then it also depends on how quickly production can make up for lost production. So none of those things are known right now. It's very, very hard.
If we grow, we grow. If we don't, we don't. This dude should have ran for politics, bro. Instead of being an appointed chairman, he should have been an elected official.
We'll be learning, I think, over the course of the next intermeeting period. It hasn't traditionally had much of a macroeconomic effect. You know, energy prices being higher, that is a significant thing. Energy prices being up can affect spending. It can affect over time, a sustained period of.
This closure right here at the 78, this is not convincing for buyers. Normally, you want to see the market respect the 70, kind of reject it and kind of give a false flag to early buyers, which we did. We saw a rejection on the 30-minute, but this is I'm still going to take the entry at the 886, but this is not looking too hot. Keeping an eye on it for sure.
You know, you're coming into this with an economy that appears to have significant momentum, and that's what we start with. And but we do have this collection of risks that you mentioned.
Right.
Greg Torres from Bloomberg News. I was a little surprised, Chair Powell, to hear you say that a soft landing is not a primary objective. This economy seeing added supply in a way.
It was a primary objective going into this year, right? Until he realized, oh shit, maybe it's not possible.
Yeah, where people can add skills. Work
Just like when he said that inflation was transitory.
manufacturing, construction. We've had a decent spate of home building. And since inflation's coming down with strong GDP growth, we may have higher productivity. All are which good for the Fed's longer run target of low inflation. And if we lose that in a recession, aren't we opting for the awful hysteresis that we had in 2010? So
Let's go. Finally, the question of the century.
thank you.
To begin, a soft landing is a primary objective, and I did not say otherwise. I mean, that's what we've been trying to achieve for all this time. The real point, though, is the worst thing we can do is to fail to restore price stability, because the record is clear on that. If you don't restore price stability, inflation comes back, and you go through, you can have a long period where the economy is just very uncertain, and it'll affect growth. It'll affect all kinds of things. It can be a miserable period to have inflation constantly coming back and the Fed coming in and having to tighten again and again. So the best thing we can do for everyone, we believe, is to restore price stability. I think now, today, we actually, we have the ability to be careful at this point and move carefully, and that's what we're planning to do. So we fully appreciate the benefits of being able to continue what we see already, which is rebalancing in the labor market and inflation coming down without seeing, an important, large increase in unemployment, which has been typical of other tightening cycles. So.
Chris.
Hi, thank you. Chris Rugaber at Associated Press. When you look at the disinflation that has taken place so far, do you see it mostly as a result of what some economists are calling the low-hanging fruit, such as the unwinding of supply chain snarls and other pandemic disruptions, or is it more a broad disinflationary trend that involves most goods and services across the economy? Thank you.
So if I understood your question, I would say it this way. I think we knew from before when we lifted off, but certainly by the time we knew that bringing inflation back down was going to take, as I call it, the unwinding of these distortions to both supply and demand that happened because of the pandemic and the response. So that unwinding was going to be important. In addition, monetary policy was going to help, It was going to help supply side heal by cooling demand off. And just in general, a lot better aligning supply with demand. So those two forces were always going to be important. I think it's very hard to pull them apart. They work together. I do think both of them are at work now, and I think they're at work in a way that shows you the progress that we are seeing.
Michael McKee from Bloomberg Television and Radio. In June, you forecast a
No rejection, no entry. All right. The way the candles are forming, let's just wait for the market to get through the zone. As soon as it goes through it, I'm going to enter my first position. And then the second one probably on the way back in, third on the retest. I said probably on the way back in, meaning we have to see if the market actually comes back in. But if it does, I will enter my second position, and then I'll enter my third position on the retest.
how much confidence do you have, can investors have, or the American people have in your forecasts?
Ooh,
Well, forecasts are highly uncertain. Forecasting is very difficult. Forecasters are a humble lot with much to be humble about. But to get to your question, though, what's happened is growth has come in stronger, right? Stronger than expected, and that's required higher rates. Unemployment, you also see that the ultimate unemployment rate is not as high, but that's really because of what we've been seeing in the labor market. We've seen more and more progress in the labor market without seeing significantly higher unemployment. So we're continuing that trend. In terms of inflation, you are seeing the last three readings are very, very good readings. It's only three readings. We were well aware that we need to see more than three readings. But if you look at June, July, and August, you're looking at, really significant declines in core inflation.
So three readings, meaning like quarterly versus monthly. So the Fed is looking at these reports on a quarterly basis. So that's how we should be looking at these things as well.
Way down, largely due to lower energy prices, some of which is now reversing. So I think people should know that economic forecasting is very difficult, and these are highly uncertain forecasts. But these are our forecasts.
There's a saying in economics: there's only two kinds of economists. There's the economist that knows that they don't know anything, and there's the economist that hasn't found out yet. All right. Projection is very hard in economics because human nature is unpredictable, and this is an ecosystem. It's a living ecosystem, breathing. So we can build frameworks around it, but it's hard to predict how the market's going to react. We'll just be like, we'll do this. Same with trading. We'll do this if the market does this.
Important at the beginning that we move quickly.
If the market does this, not when the market does this. Difference.
We think the stance of monetary policy that we think is appropriate to bring inflation down to 2% over time, the risks become more two-sided, and the risk of over tightening and the risk of under tightening that becomes more equal. And I think the natural common sense thing to do is, as you approach that, you move a little more slowly as you get closer to it. And that's what we're doing. So we're taking advantage of the fact that we have moved quickly to move a little more carefully now as we sort of find our way to the right level of restriction that we need to get inflation back down to 2%.
Jennifer. Thank you, Chair Powell. Jennifer Schonberger with Yahoo Finance. With your focus on year-over-year PCE, isn't it true that base effects are huge, and that by the time you meet in November, that it's more likely that you'll have a low PCE number that would make you feel more comfortable? And secondly, how would the lack of key indicators like CPI, the jobs report, impact your approach in upcoming meetings if we were to have a government shutdown? Thank you.
Yeah, I missed the first question. What was what factors?
The base factors.
Base factors. Okay. So on that, we're looking at just monthly, right? You can look at just monthly readings and see what the increase was from the prior month. So you're right. When you go back.
No, I'm kind of looking at NAS's action, and there's a good chance here that we break through the 88.6 and come down to this extension level. So I'm going to enter my first position here at the 886, but I'm going to put my stops and break even. There's a good chance that it's going to push up a little bit and then come straight through. I think this 15,000 area is going to be the best place for us to go long. Second opportunity, this would actually be a much better bet right here. All right, so I'm still going to take the scalp position at the 88.6 in case this is the You know, this really could be the low. But there's two trade ideas here. This one would be lower risk.
We can tell how much inflation has gone up in a given month, right? And, you know, that's what we're looking at. And month by month, what's the reading? And, you know, I think what we're really looking at is there's a tendency to look at, you know, shorter and shorter maturities, but they're incredibly volatile and they can be misleading. That's why we look at 12-month. But I think in this situation where it looks like we've had a bit of a turn in inflation starting in June, we're also looking at 6 months and even 3 months, but really 6 months inflation. So you're looking at it over that period and over longer periods. That's the right way to go. And we don't need to be in a hurry in getting to a conclusion about what to do. We can let the data evolve.
Thanks for the question, Chair Powell. Edward Lawrence with Fox Business. So I want to focus back in on oil prices. We're seeing oil prices, as you mentioned, move up, and that's pushing the price of gas. So how does that factor into your decision to raise rates or not? Because the last two inflation reports, PCE and CPI, we've seen.
This is the question I want to know, because oil prices are kind of holding the economy together. They're kind of keeping inflation down. But any rise in oil prices is going to bring inflation right back up. I'm putting in my first position.
Certainly can affect consumer sentiment. I mean, gas prices is one of the big things that affects consumer sentiment.
My stop loss is at 15,055. Make sure you match up the prices if you do take the trade. It's like, you know, do your own diligence. But you guys can see that my Owanda chart says 120. This FTMO chart says 103. There's a 20-point disparity or difference in prices. And so I'll adjust my stop. If the stops here are 75, then I'll subtract 20 points, and then over here it'd be 55. So below the low. Or you can just look at structure. 15, 20 points below the recent structure, 15, 20 points below the recent structure.
Expectations of inflation, things like that. That's just things we have to monitor. So
on the consumer, they're putting more and more of this on their credit card. The consumer seeing, you know, record credit spending. How long?
They're asking them the hard questions.
Debt at higher interest rates now, and are you concerned about a debt bubble related to that?
So to finish my prior thought, I was saying that's why we tend to look through energy moves that we can see as short-term volatility. You know, turning to consumer credit, you know, of course we watch that carefully. Consumer distress, measures of distress among consumers were at historic lows quite recently. You know, during and after the pandemic. They're now moving back up to normal. We're watching that carefully, but at this point, these readings are not at troublingly high levels. They're just kind of moving back up to what was the typical in the pre-pandemic era.
Hi, Jean Young with M&I Market News. Yields along the Treasury curve have risen to their highest in years. What is the Fed's view about what's been driving that increase in recent weeks? And how much of it can be attributed to macro explanations and how much to technical factors?
So you're right. You know, rates have moved up significantly. I think it's always hard to say precisely, but most people do a common decomposition of the increase, and the view will be it's not mostly about inflation expectations. It's mostly about other things. You know. Either a term premium or real yields. And it's hard to be precise about this. Of course, everyone's got models that'll give you a very precise answer, but they give you different answers. So, but essentially they're moving up because it's not because of inflation. It's because it'll probably have something to do with stronger growth. I would say more supply of treasuries. You know, the common explanations that you hear in the markets kind of make sense.
Hi.
Kyle Campbell, American Banker. Thank you for taking the questions. Just two on housing. You said slower shelter cost growth is in the pipeline and will reflect in inflation readings as new leases are signed. But there's also some questions out there about the way housing costs are measured, particularly the use of rental equivalents, which are estimates from homeowners about what their homes would rent for if they were in the rental market. So my question is, how much of the effort to tame inflation, both as it's measured and felt by the broader public, hinges on housing supply? And then as far as a constrained housing supply being sort of exacerbated by this sort of lock-in effect of mortgages being higher now than they were at their recent historic lows, how is that going to impact future thinking about taking interest rates to that lower bound in the future?
So on the supply point, of course, supply is very important over time in setting house prices and for that matter, rents. And supply is kind of structurally constrained. But in terms of where inflation is going in the near term, though, as you obviously know, a lot of it is leases that are running off and then being re-signed or released at a level that's it won't be that much higher. It would have a year ago, it would have been much higher than it was a year before.
A lot of the stuff that he's answering right now is just basically confirming every question that people are asking him. They're like, hey, the economy's shit. And instead of what he normally does, which is kind of like not deflect it, but give an argument for why it's not in shit, he's kind of like, yeah, housing sucks. Yeah, that's going to hurt consumers. Yeah, people are going to lose jobs. He's just confirming everything.
Potentially bring rates.
So the person who's asking about what the bearish scenario is, well, it's really just Jerome Powell confirming to everybody that we're in a horrible economic state and that this is going to end up, resulting in maybe one more rate hike, and then which is going to lead to a recession. So I think that, I don't know, the markets are reacting right now. It always takes at least 7 to 8 hours after the press conference to get a sense of the real direction. So right now, I think we're still in that waiting period, and we just got to see how that goes.
Decisions in a future future loosening cycle about whether we would cut rates. No, I don't think it would. I mean, I don't think that's. I think we'd be looking at what fundamentally what rates does the economy need, and in an emergency like the pandemic or during the global financial crisis, you have to cut rates to the point that you have to do what you can to support the economy. So I wouldn't think that would be a reason for us not to do that. It's not something we're thinking about at all right now, but down the road, I wouldn't think so.
Yeah. Hi, Nancy Marshall-Genzer with Marketplace. Chair Powell, you've mentioned several things that would possibly weigh on consumer confidence, maybe cut back consumer spending.
Whoever asked in the YouTube, she's about to ask the same question to him. So he's about to answer it.
Consumer spending, would that help you get inflation closer to your 2% target?
I wouldn't say it that way. We're not looking for a decrease in consumer spending. It's a good thing that the economy is strong. It's a good thing that the economy has been able to hold up under the tightening that we've done. It's a good thing that the labor market's strong. The only concern, and it just means this: if the economy comes in stronger than expected, that just means we'll have to do more in terms of monetary policy to get back to 2%, because we will get back to 2%. Does that answer your question?
Yeah, and I guess on the other hand,
Dollar's back on the climb, which means UJ and EU be dropping. UJ will be continuing to the upside. Again, these directional moves are good, but we don't really get a sense of the direction until probably 7 to 8 hours after the Fed meeting, which will probably put us right at the beginning of London session. So the markets are moving in a specific direction, which could be the move for the day. Right now, NAS is crashing, which means sellers could be taking over for the day, obviously. So might have to give it up to the sellers and then come back during London session and see what the direction was.
With our rate hikes and how quickly we've come here, we do have the ability to be careful as we move forward because of that consideration.
Thank you, Chair Powell. Simon Rabinovich with The Economist. One of the factors in the economic resilience to date appears to be a lesser degree of rate sensitivity than in the past. Obviously, we've talked about households with long fixed rate mortgages, also companies that refinanced before last year. What is your thinking about the efficacy of rates and how that's changed? And then related to that, how do you think about the distributional consequences in the sense that if you're a relatively wealthy household with a long fixed rate mortgage, the past year has not been all that tough with rates going up. Whereas if you're relying on your credit card for supporting your consumption, in fact, times are getting a lot tougher, a lot more quickly. Thanks.
So I guess it's fair to say that the economy has been stronger than many expected given what's been happening with interest rates. Why is that? Many candidate explanations. Possibly a number of them make sense. One is just that household balance sheets and business balance sheets have been stronger than we had understood. And so that's spending has held up and that kind of thing. We're not sure about that. The savings rate for consumers has come down a lot. The question is whether that's sustainable. That could be, it could just mean that the date of effect is later. It could also be that for other reasons, the neutral rate of interest is higher for various reasons. We don't know that. It could also just be that policy hasn't been restrictive enough for long enough. And there are many candidate explanations. We have to, in all this uncertainty, make policy. And I feel like what we have right now is what's still a very
here's what I got for gold.
strong.
I know some people were asking 1942 retest
making progress on inflation
for shorts.
By many forecasts, many forecasts call for growth to moderate over the course of the next year. So that's where we are, and we have to deal with what comes. On your second question your second question was distributional, but can you be a little clearer about that?
Yeah, my point there was that if you're somebody who has a long fixed rate mortgage, you've been able to endure the higher rates relatively easily. If you're somebody who's living month to month off of your credit card, current financing rates are punitive.
Yes. And so the point I would make there is that we're trying to get inflation back down. The people who are most hurt by inflation are the people who are on a fixed income. If you're a person who spends all of your income, you don't really have any meaningful savings. You spend all your income on the basics of life: clothing, food, transportation, heating, the basics. And prices go up by 5, 6, 7%. You're in trouble right away. Whereas even middle class people have some savings and some ability to absorb that. So it is for those people, as much as for anybody, that we need to restore price stability. And we want to do it as quickly as possible. Obviously, we would like to do that. We'd like the current trend to continue, which is that we're making progress without seeing the kind of increase in unemployment that we've seen in past things. But you're right, though. When we raise rates, people who are living on credit cards and borrowing are going to feel that more. They are, and of course, people with lots of savings also have a much lower marginal propensity to consume, and so it's not going to affect them as much.
Let's go to Greg Robb for the last question.
Thank you, Chair Powell. Greg Robb from MarketWatch. In the Beige Book recently, you can tell that the Fed has been surveying nonprofits and community groups about the economic health of low-income Americans, moderate growth Americans. I have two questions about this. Are you going to use that data to maybe come up with sort of like a quarterly survey of those groups, like the Senior Loan Officer Survey? And also the second question is, from your recent readings of these surveys, how are low and moderate Americans doing? Is there this thing where like the GDP is strong because of wealthy Americans kind of driving things? I just want to get your sense of the health of that sector. Thank you.
So I don't know about the quarterly survey. That's an idea we can take away and think about. In terms of how low and moderate Americans, they're clearly were suffering from high inflation. I think during the pandemic, the government transfers that happened were very meaningful. And if the surveys that we take showed that low and moderate income people were actually in very, very strong financial condition. I think now it's a very hot labor market, and you're seeing high nominal wages, and you're starting to see real wages are now positive by most measures. So I think overall households are in good shape. Surveys are a different thing. So surveys are showing dissatisfaction, and I think a lot of that is just people hate inflation, hate it. And that causes people to say the economy is terrible, but at the same time, they're spending money. Their behavior is not exactly what you would expect from the surveys. That's kind of a guess at what the answer might be, but I think there's a lot of good things happening on household balance sheets, and certainly in the labor market and with wages. The biggest wage increases having gone to relatively low wage jobs, and now inflation coming down, you're seeing real wages, which is a good thing. Thanks very much.
That's a quick ending.